Hi, this is Joe Rabil. Wanted to get back and talk a little bit about one of the other patterns that I really like to keep an eye out for, which is a 40 to 18 bounce. Um, and I think there's some subtleties to the pattern that you have to be really careful with. They're not, it's not going to be a perfect world when you're looking at chart patterns. I know there's textbook versions and then there's real world versions. And I think you have to take into account this is why I say in my book, I Invest Like a Pro, that I really don't think you want to use technical analysis as a science. I think you're much better off uh, looking at what the spirit of the signal is and combining it with other elements. And I think that's really going to be the deciding factor for you in terms of your success. So I'm looking at a long-term chart of Hershey. I'm gone back to the 2009, 2010 period. This is the circled area here on this monthly chart. And I do want to make a point of something. Sometimes I'll go back and look at a long-term pattern. It is not because I'm not going back 10 years because I can't find a good example from this year or from this month. The reality is this was a pattern that I actually recommended to my clients back in 2009. And I want to also prove the fact that these signals don't change over time. I mean, this is going back 10 years. This is the same pattern that I could go find on a daily chart that's taking place right now. So I think it's important to recognize a couple things. Sometimes I'll go back in history because it was just a great example of something that I did in real time with clients and said, hey, this is a great pattern. This is a great setup. So I just wanted to explain that. So as we look at this Hershey chart, we see starting in 2005, it peaked and dropped down, got down and had a declining 18-month line. And then notice what happens on the rally. In 2009, it didn't actually make it all the way to the 40. And this is why I say not every pattern is going to be picture perfect. You're not going to have this, okay, hits the 40, comes back and touches the 18 and then takes off. If you go through my book, I'm going to give you the details. I give you the details of the exact pattern and what really we're looking for. But I think you have to take it in the context sometimes. So I'm just going to draw in and say, you know what? One of the things that really attracted to me to this pattern back in 2009 was this break of its long-term downtrend. I mean, that trend was in place for 2 or 3 years and you broke the trend line. In most cases, I would say 80 to 90% of the time, you're going to get a rally on this break of the downtrend that's actually going to touch the 40. In this case, it came a little shy before it started the pullback. I would still consider this to be, a 40 to 18 bounce. But I think it's real important to recognize that the driver of this of my multiple time frame analysis is using the 18 MA. And in this case, if I'm focused on the 18 MA, you had a declining line all through this period until this period where it started to flatten out. And this is really the first time you pulled back into the area of the 18 and held it. I mean, for all these years, it was failing below it. In this period, you tried to get through it. Now you break above. Now you're pulling back and it looks like it's trying to hold. This caught my eye. And the other thing that caught my eye was the MACD lines. So again, all through this period, the blue line, which is the signal line, was on top of the MACD line. It couldn't get across. Then it finally got across in late 2008, early 2009, and actually developed into this pullback actually was a pinch play on the monthly chart. That is another pattern that's one of my favorites that I look for. Again, it's in my book. So if you go through that, I think and I actually have some videos on pinch plays as well. So this gives me the bias. Now, I don't like to trade off of a monthly chart. I like to use the monthly as the bias that says, you know what, there's something pretty big that looks like it's developing on this time frame. So I want to go down and I'm going to move this over so we can look at the weekly chart. I'll zoom this in a little bit so we can see. So I've broken the downtrend and then I've come back and tested this area. So if the 1, 2, 3 change in trend, again, that I just have discussed in the past is you're breaking the trend line. That's 1. The test of the low, that's 2. And when you take out this high, this prior peak up around 42, that would be the 3 change in trend signal. Now, when this is taking place on a monthly chart, I really don't want to wait for confirmation on a monthly chart and buy it way up here 2 or 3 months later. When I see the development taking place and I'm starting to get an idea that there's a shift going on, especially with the 18-month cupping around and the MACD line showing me some signs of improvement, I want to go down to a weekly chart. And in this case, we can see this is the remnants of that trend line break. And we rallied up and then we come back down and look at what takes place. So it's very, very quick, but this still qualifies as a sell signal that fails because we get the 18 to cross down below the 40. And what I've said in prior videos, I'm looking for that opposing trend. I want the 18 below the 40 in this case. And I want to see price go into the zone and out of the zone. Very, very subtle. I mean, this is something you have to be on the lookout for, and you got to know what you're looking for on the higher time frame. Otherwise, you'll never see this pattern on the weekly. Now, you did get a crossover signal where the MACD crossed over the MACD signal line. That took place on this big, huge green bar, and there's absolutely nothing wrong with waiting for that confirmation and saying, you know what, I can get in this at 40 and my risk is maybe about $4 or $5. And the reality was this thing moved up for several years because you had a big shift in trend developing on the monthly chart. But let's just say I'm looking at this on the monthly. I know there's something going on. The weekly has pulled down. I'm in this little zone here. I'm just going to tighten this up a little bit. I've gotten down to the point where I am right in this area here because the 18 has crossed down below the 40. You know, the MACD has turned up, but it hasn't crossed over yet. I'm going to switch this chart, this one on this side, to a daily, and I'm going to go back in time and find this circle. Just give me a second here. It's way back in time. So as I look at this now, in the book, I only discuss using 2 time frames, and there's absolutely nothing wrong with going about it this way. You can go down to the weekly and enter off the weekly, and that is absolutely no problem. However, if you were to go down to a daily time frame, I think it adds an extra element in this case because, again, I'm zeroing in on this, and then look what happens. If I go down to a 3rd time frame, I actually get the buy signal in this where the 18 crosses above the 40, pulls into the zone and out of the zone, and I know I've got some improving bias taking place. Now, it's a little choppy. By the time you go in the zone and out of the zone, you've already made a couple peaks here in January of this year. So I'm sort of thinking 38 is a pretty key level on the daily chart. If you take out 38, I think it's the start of a new trending move. I've got the MACD lines on the daily chart crossing over the 0 line and showing some pretty good improvement. But I really want to see price take out this 38 level. Now, it's not a phenomenal entry point, but you've improved your entry from the weekly. Because if I'm waiting for the weekly signal to cross the signal line and I'm waiting for this big bar, I'm up around 40. If you do it off a daily chart, you've now reduced your entry down to say around 38 or so. And again, you could probably get your risk at 36. That would be the prior low. If you wanted to be real aggressive, you could play it here. The tighter the stop, the higher the probability that you get stopped out. And when I'm looking at a big pattern, one that's taking place on a monthly chart, I don't really want to be too tight with the stop because I know something big is developing. So that is basically, I just wanted to kind of focus in on say, look, we're starting with the wide angle lens on a monthly chart. We're looking at some pretty significant things taking place. I'm going down to the weekly. If I get perfect opportunity on the weekly to enter, that's great. If not, I'll go down to a daily chart to refine the entry even more. Hit the like button and subscribe if you want to see more videos like this. Thank you.